It's a sea of red on Dalal Street. The sensex loses over 1,500 points. Nifty is down over 2%. Shares on BSE see their market capitalization decline by 4 lakh crore rupees.
HDFC Bank shares mark the worst single-day fall in 3 years, wiping out over 1 lakh crore rupees in market capitalization. The street gets spooked by a deterioration in the credit deposit ratio and liquidity coverage ratio in the third quarter. HDFC Bank accounts for more than 50% of the fall in the Nifty.
Bank stocks see profit booking across the board. Nifty Bank Index sees the worst sell-off in over 2 years. Except Bandhan Bank, all bank stocks end in the red.
Hello and welcome to a fresh new edition of Markets Forward, the show where we aim to get you everything that you need to know, the key data points as you gear up for another trading session. Today was a down and out, sullen kind of day. I am Prashant Nair, with me my colleague Surabhi Upadhyay. Surabhi, hi.
Hi, Prashant. Well, we've almost, forgotten to use phrases like biggest fall in X number of months and, X number of weeks. But today was one for the records on the way down because we had the biggest fall in 2 years on the headline index, the Nifty, and the biggest fall in 3 years on the bank Nifty. Quite a day.
Quite a day, and we've broken some averages, etc. as well. So just to quickly recap where all of this, after everything over the last 6-7 hours, leaves us at, you basically had a situation where the Nifty ended just below, about 50 points under the 20-day moving average. Now, this is happening for the first time since October of 23. Since the rally began, that sharp surge through October, November, December, late October actually, and it never stopped. The top, of course, was made late in December. So we've ended below the 20-day simple moving average. This is, it's not a very conclusive close. It's not 150, 200 points below the 20-day, but we started much higher, and by close, we got a 50-odd point close under this one. Now, this is important because previous sort of conclusive breaks of the 20-day moving average. Whether it's conclusive or not, you'll only know in hindsight. But the point is, previous such breaks, and I looked at 4 such instances, has resulted in between 5 to 10% falls. The last one was in 23. We, of course, have 2 or 3 of those in 2022. And of course, the frequency of falls became lesser and lesser. The degree also became lesser. And that's why we're not used to these, right? Bank Nifty, we broke, the Bank Nifty has been below the 20-day for a long time. It broke the 50-day today as well. And it also broke the October to December rally. If you basically take a Fibonacci retracement, it broke 38% retracement. And as of close, we're at the 50% retracement of that rally. That number stands, the support stands at 46,140. We left off at 46,064 or so. So I think... So we'll see where we go from here. Global cues, I think, are also suddenly back into the mix. Till a few days back, it didn't matter. Global markets were up or down. But today, it was not just a fall in India. Hang Seng was down 4%. Kospi was down 2.5%. So I think that also, and of course, a lot of chatter around why the dollar is starting to strengthen once again. The dollar index, by the way, is almost at the 200-day moving average and things like that. So I think, today was a day to digest these big falls, led, of course, what happened with HDFC Bank. And tomorrow will be, in that sense, day 2, where we'll really get to know whether we are actually, for the first time after a long time, opening up a little bit more on the downside, maybe a few percentage points. Surabhi.
Oh, yes, absolutely. It was quite a bear cocktail today, coming together of all kinds of events that just, made this fall happen, and, pretty exaggerated one at that. I just want to point out that some of the global markets were down quite a bit. The Hong Kong market, for instance, was down 3.4% today, and it was reacting to the Chinese GDP data that came out. And then, of course, you had U.S. bond yields staying above the 4% mark throughout the time that we were trading because of the uncertainty around the pace of rate cuts that we will see the Fed deliver today. The other problem is that while banks were falling, there was nothing else to make up for it. So if you see the contribution chart on the Nifty, that'll kind of explain the problem. You had some buying on large cap technology, but very, very little, very feeble, and definitely not enough to counter the force of the fall. So you've got the banks on on the red side of the screen. On the right side, you've got Infosys, TCS, but it wasn't enough. If you talk about the bank nifty itself, it was a one-way street, as we told you in the headline as well. What happened with HDFC Bank sparked a major risk-off across the sector, across large-cap banking, even mid-cap banking for that matter. Now, if you look at the nifty losers, apart from banks which were down, today there was profit-taking in auto, there was profit-taking in a lot of metal stocks as well. Metals was a weak part in any case because we were telling you about the weakness in the Chinese and the Hong Kong markets. And Reliance also didn't quite play ball, so to speak. There was no support coming in over there. So in the absence of any of the other heavy hitters performing, IT and whatever little it could do was clearly not enough. The net result was a break of the 20 DMA on the Nifty and record lows, 3-year lows for the Bank Nifty as well. Well, let's tell you about the lineup that we have on the show today. Lots to discuss, lots to talk about. We will start off with the top movers of the day, get you a little more color on the stock-specific action. Two stocks that stood out and that were in focus. One, of course, no prizes for guessing this one, HDFC Bank. The other was a green stock, actually, ICICI Lombard, that reacted very well to its earnings. So we will focus more on them. Last but not the least, we will delve into the key market events to watch out for tomorrow as well. So that's coming up in a bit. But first of all, let's go over to Hormaz and get a sense of the top movers of the day. Hormaz, more on the way down than the way up, I guess.
When you spoke of color, the dominant color of the day was indeed red. And you can't, as I said, they're not used to having days like these when the indices drop over 2%, biggest fall in almost 2 years and 3 years. And the lead contributor to that was HDFC Bank, and you can't not talk about it. 55% of the Nifty fall came via HDFC Bank, and today's drop resulted in the lender shedding market cap worth over 1.1 lakh crore rupees. And all the way, other banking stocks, as you mentioned as well, saw profit booking from higher levels, and all the constituents of the Nifty Bank ended lower today, barring Bandhan Bank. And you can see there Kotak Mahindra Bank, IDFC First, Axis Bank, ICICI, all of them contributing towards the fall. The other major sectoral loser other than banks were metals, and that was because of the weakness emerging in China. And the Nifty Metals Index was down nearly 4% today. SAIL, Tata Steel, Nalco, JSPL, all of them among the top losers on the index, anywhere between 3.5% to 5% today. The other major loser, the top mid-cap loser on today's session was IEX, and there were some issues regarding news flow regarding the pricing mechanism there. The biggest single day drop there as well since March of 2020, 10.5% lower on IEX, and it also broke below its 50-day moving average today. But the dominant color was red, but there was some green on the screen as well, and unsurprisingly, it comes from PSUs, mainly from shipping PSUs, and those were Cochin Shipyard, Mazagon Dock, and Garden Reach. Yet again, IRFC another 5% higher today, market cap almost at 2 lakh crores, and RVNL another 7.5% higher. PSUs remain untouched, but the market is surely in a fall.
All right, Hormaz, thanks very much. It's a pretty exhaustive sort of look at what happened, what went up and what went down first. And of course, some of what went up as well, and that was largely PSUs. Well, it's the biggest fall for the Nifty in 2 years, led by banks. Market watchers believe that this is a correction and something to be expected after the massive run-up that we've seen recently. We spoke with a whole host of experts, both local and foreign. Listen in to some of that opinion that we got through the course of the day.
I am concerned because I think to maintain the powerful rally that the Indian market enjoyed in 2023, we need a bit of sector rotation. And I would actually argue that this is also true in the global markets, where you needed a sector rotation towards financials. And to some extent, that is actually what has driven the more recent moves in the US and European markets. And in India, we're not getting the rotation. And that does make me a little bit concerned that this rally may not have the legs that you would get if it was a more broad-based rally. So the specific HDFC news, if you project that across the rest of the financials in India, is definitely an important negative for maintaining this rally.
I think that private banks are still not a great risk reward, both from a cycle perspective and from a structural perspective. If CASA is becoming an issue, then I think there is a threat that these high multiples may not sustain, because obviously if CASA doesn't grow very fast, then the spreads could be under a lot of pressure. CASA growth is definitely lower than in previous cycles. So I think we need to be careful about being overweight on private banks at this point of time.
just a one-day move, nothing much to read on it except that the markets were overbought. We had a very strong performance over the last few weeks, and the market just wanted a reason to book profits, and it came via the HDFC Bank results. So nothing much to read into it. Nothing much has changed except that one result was not in line, and it was an overbought market. So we can't be rallying all the day non-stop.
Absolutely. And the market reminded us of that it does not travel only one way. Let's welcome in our guests on the show now. We have Shilpa Rout of Prabhudas Lilladher and Mayuresh Joshi of William O'Neill. Ladies and gentlemen, thank you for joining in. Shilpa, first to you. I mean, I don't know, levels were coming and going today, 50 DMA, 20 DMA. It was all being tossed around on the Nifty and the Bank Nifty. What's your advice now?
Is just to wait till tomorrow. We had been getting endless queries today what to do, and of course the levels the levels were getting breached on the downside one after the another. 21,700, 21,600, now 21,500 acts as a good support with a considerable amount of put writings in there. But the more clarity on this, whether it is a correction or just a one-day set-off because of the results, will be clear tomorrow. If we see some sort of follow-through tomorrow and this 21,500 levels are held, then we might see a move towards again 21,800 to 850. Otherwise, the support zones then goes very deep down towards 21,000, 20,900 zones.
Mayuresh, quick thoughts on Nifty. Are we starting a bit of a pullback downturn?
Might be, Prashant, and as we see it at Markets with India, I think we do have a distribution day count in terms of how sectors and the indexes are placed. We've seen some element of distribution days punch up as per our cancelling methodology. And therefore, as Shilpa is saying, I think we would like to wait out. 21,050, the 10 weekly moving average, is very, very important in our opinion. That's 2.55% away as we speak. And if there is any breach expected on the index, a few of the key leading sectors like banks, IT, infra, FMCG might actually crack their near-term moving averages as well, with leadership stocks also cracking down. So I think we'll wait out for the next couple of days. It doesn't seem to be a structural fall per se, looking at the macros and the micros surrounding the markets. But yes, what happened with HDFC Bank was a precursor in terms of some profit being taken off the table by the street itself. So I think we'll watch out for those levels at Markets with India.
No, point taken. I mean, it doesn't have to be a fall, right? I mean, it can just, you can have a topping out kind of a thing where the market does nothing for a while, right? Just spends time sideways, which is time-wise correction, which also is important. Now, HDFC Bank, let's shine the spotlight on that one in a more detailed kind of way. Biggest loser, biggest contributor to overall losses and causing a lot of collateral damage in banks as well. Abhishek is here to tell us more. Abhishek.
Well, the key highlight of HDFC Bank results was the sharp decline in its liquidity coverage ratio. The entire focus in the result was down to credit deposit ratio being at 110%, which is perhaps the highest in the sector, and also due to the fact that HDFC Limited book has now been merged with the bank, this ratio looks to be on the higher side. Another focus was the liquidity coverage ratio, which declined sharply to 110% versus 121% in the previous quarter. The sharp decline in liquidity coverage ratio was due to strong loan growth, for which the bank used part of the GSEC portfolio for growth. Hence, in the near term, deposit garnering is necessary and it would come in at a cost, or the bank would have to slow down on the loan growth momentum. Either ways, the most important factor to get affected is the net interest margins. HDFC Bank reported net interest income which was lower than our poll. However, thanks to sharp rise in the treasury gains, which grew more than 41% quarter on quarter, the top line growth, or net income as we call it, that growth was on the healthier side on a sequential basis. So what to read through HDFC Bank's number for the sector? The best of net interest margin is behind. Now, owing to rise in cost of funds, the best of return ratios is also behind. And owing to net interest margins and provisions, that is provision expected to move upwards, which means the credit cost will start moving up. Now, RBI's new risk weight asset norms will impact capitalization of many banks in Q3 FY24. Banks can see, sharp rise in risk weight asset to advances ratio on a sequential basis, that is on a Q-on-Q basis. Loan growth can moderate from current levels in the coming quarters as deposit growth is slowing down for the entire system. One One of the reasons for slower deposit growth could be perhaps that people are finding various alternates as well in lieu of keeping their money in deposits like capital market, etc. Brokerages have remained upbeat on HDFC Bank with respect to their recommendation and target prices. They say that there are two key things to monitor are the liability, ability to raise the liabilities, and that is for deposits, for growth come borrowing repayment of the borrowings that they had for HDFC Limited, and net interest margin trajectory. It is the first time that on a YOY basis in a decade that you are seeing an EPS decline. Now, disappointment in the quarter was the LDR ratio, and replacing high cost borrowings of HDFC Limited with deposits will be a long drawn process. So in their view, the improvement in net interest margin is critical for the re-rating of the stock. All the brokerages are bullish on the stock with ratings of buy, outperform, overweight, add, etc. HSBC is the only brokerage to cut the target price to 1,950 from earlier target price of 2,080. Brokerages target price now ranges from as low as 1,950 to as high as 2,200 for HDFC Bank. In the con call, management has highlighted that their lending deposit ratio can go down for several quarters to come. They don't want growth for the sake of growth, meaning to say they will not chase growth for the sake of it. They will have to replace borrowings with deposits and grow further loans with deposits as well, indicating that deposit growth is the key for HDFC Bank going ahead.
All right, Abhishek, thank you so much for that. What a saga there. And despite all those buy calls that keep coming in, it remains one of the worst performing stocks on the Nifty in the last 1 year. If you strip out Adani Enterprises, it had lots of issues, court case, etc., and strip out UPL, which is in a dam and chemicals have been in a down cycle for a long time, strip out those two, then HDFC Bank is the worst performer on the Nifty in the last 1 year. Let's go back to our guests for a quick word on this one, Shilpa as well as Mayuresh. Mayuresh, now for an investor, not a trader, for an investor, is this a buying opportunity? But the thing is, the stock has been testing investors' patience already for the last 1 year.
Oh, absolutely, Surabhi. And to that extent, our sense is to just put a couple of pointers more to what Abhishek mentioned. Will this be a trend for the industry as a whole over the next few quarters till we see the first signs of a rate cut emerge at some point in the second half of the next financial year? Till that point of time, deposit mobilization is going to be a key issue for the sector as a whole. And if all banks are probably going to chase deposits, it is going to show in some respect on the names and spreads for these banks. The second element, obviously, is that within the overall universe, I think PSU's deposit garnering has been a tad bit better than the private space. And to that extent, the cost of deposits for PSU banks relatively better place. But coming to HDFC Bank in particular, my own sense is that it will spend some time in a consolidated zone. We're looking at key pivot levels at 1670, 1680 odd levels for the bank to probably take out if it has to show a sustainable good move on the upside. Till that happens, I think a sideways move, because a large part of the price damage is probably in the price as we speak.
All right. That's the big stock of the day, HDFC Bank. Mayuresh, thanks for joining in. Thanks for staying on. Appreciate your time here on CNBC TV 18. Shilpa, it's always a pleasure having you with us here with those technical views as well. We'll take a quick commercial break here, but we'll come back and we'll put the spotlight on the events to watch out for as we return tomorrow morning. Welcome back. You're with us here on Markets Forward. We've been talking about everything which was down, banks and HDFC Bank, etc. But there were some stocks which were higher as well and sharply higher. And, we were talking about PSUs as a pack which was up, but there was one other singular name which rallied at the back of strong earnings. ICICI Lombard is what I'm talking about. 6 or 7% gains, I think, by close. Yash is here to tell us more. Yash.
Well, that's correct, Prashant. So in a weak market, what a stellar rally ICICI Lombard saw today. And there were two important reasons for that. The first one were the results itself, which came post-markets yesterday. As far as the results are concerned, strong top-line performance and even better operational performance. The net earned premium for the company, that grew by about 13.5%. Underwriting loss for the company, that reduced by about 4% in this quarter. Also, the combined ratio for the company, that came at about 103.6%. versus 104.4%. The management in the con call also spoke about, if the catastrophe losses in this quarter were to be excluded, then combined ratio improves even further to about 102.3%. This was, of course, about the headline numbers, but operational numbers also seemed very strong. Health premiums, that grew by about 37%. Retail health underwriting profit came at 2 crore versus loss of 11 crore. Motor underwriting profit, that almost doubled in this current quarter. Also, marine premiums grew by about 21%. This was one reason. The second reason was valuation comfort. The stock's done practically nothing in the last 6 months. In fact, in the last 7 days, the stock is down about 7%. So it was valuation comfort coupled with good results, which sort of, drove the stock price in today's trading session.
If you look at this industry over the last 15 years, it has kind of grown at a compounded rate of almost close to between 15 and 16%. And given the market opportunity that it presents, there is no reason why this market should not continue to exhibit growth around those levels in the range of 15 to 20%. So as we kind of head into even, let's say, FY25, that's what we would be kind of penciling in, depending on how we see different segments play out. As I said, insofar as ICICI Lombard is concerned, I think we would want to kind of continue to maintain that alpha of 100 to 200 basis point over market growth numbers. Pretty much what we have talked to the market is to try and get to a combined ratio of 102% by end of FY25. Now that thought process continues as we speak. Obviously, this has to be looked at in the context of where the market is operating at. So for example, if you look at the industry combined ratios, which is available at a lag of a quarter, industry combined ratios are operating at about 112. This number, if you would have looked at first half of last year, that number was about 116%. So there seems to be some kind of an improvement in the overall industry combined. And if the industry improves further from here on, then to that extent, obviously, we would also kind of want to recalibrate the 102% objective that we have set for ourselves by end of FY25. But as of now, we're kind of sticking to the guidance that we have talked about to get down to 102 by end of FY25.
All right, that was ICICI Lombard, managed to hold out in the green in an otherwise very red-looking market. With that, let's move on and talk about the key events to watch tomorrow. Sonal is here with all the details there.
Thank you for that. Well, a lot of earnings which we're expecting tomorrow, the big one being IndusInd Bank, and after the shocker from HDFC Bank, it will be important to track that one. Polycab, apart from the numbers, some word on the IT raids as well. There's India Mart, Finolex Industries, Home First Finance, Mastech from the IT space, where Metro Brands, Shoppers Stop and Tata Communications, some of the bigger ones that we'll be tracking very, very closely. There is a conference call as well coming in from IIFL Finance, so watch out for that one. There's Investor Day for Mrs. Bector's Food, so that one will be tracked as well. In terms of global events, ECB minutes will be published, so any commentary and more details in terms of rate hike trajectory is something that we'll be watching out for. In the US, the housing stats for the month of December and initial jobless claims will be out tomorrow as well. And the oil market report from International Energy Agency will also be out.
Okay, well, that's a long list of things to watch out for, and I couldn't help but notice Sonal's shoes. Let's see. I think she's going to start running right away.
We should.
All right, I think that gets us to a close on this edition of Markets Forward. It's goodbye from all of us here, the entire team. But stay tuned, news and updates follow on the other side.